So the Indian investment battalion of Make My Trip first came to Mauritius, reunited with the worldwide investors there, and from this Mauritius, they went to US Stock Exchange. Why? Because under India-Mauritius DTAA, dividends paid by a Mauritian company to an Indian shareholder are subject to 0% withholding tax, compared to other countries where the withholding tax for the same is 10 to 20%. This significantly reduced the tax burden on Make My Trip shareholders. Let's say for an example, Indian investor holding Make My Trip shares worth rupees 100 crore. If Make My Trip were listed directly from India, the investor would have faced 10 to 20 CR of taxes. However, with Mauritius route, he paid Shunyatax. Other than that, the DTAA also reduces capital gain tax on the sale of Make My Trip shares. Gains realized by Indian residents by selling shares of a Mauritius-based company are taxable at 10% compared to 20% if the listing was done by India. Along with that, the global perception that the whole worldwide investor have for India and for Mauritius. Mauritius has a better reputation for international financial center. Along with that, the forex regulations of India are on a whole different level. If you have done some forex transaction from India, you'll know that it is a mountain in itself, which is totally not in the case of Mauritius. Plus, whatever gains the investor realized from Make My Trip NYSE, they had plans to acquire companies globally like GoIVivo. So basically, there was no point of bringing money back to India as they planned to invest it outside India again. And that is why Mauritius was much optimal choice. And if they brought the money back to India, they would have paid at least 30% of taxes for the earnings by Make My Trip, which actually is nil until last year.